Assalamu alaikum friends. In this series of videos, we shall discuss the divisional performance evaluation when an organization is divided into divisions. So, how the objectives should be set, the benchmark should be set, and how the performance should be evaluated, especially the financial aspect of the performance evaluation. So, we used to say these are the responsibility centers, and we will see how their performance evaluation and is done and what are some of the challenges. So a responsibility center is basically a department, an organization unit within an organization for which there is a manager that has been assigned and that is responsible for the conduct of that particular department. He has been given certain objectives to meet, and broadly these kind of organization units, maybe departments or business units, can be either the cost centers or what the book author recommends as labels as expense centers, or they can be profit centers or revenue centers. And the expense centers can be further subdivided into engineered expense centers and discretionary expense centers. We shall see its details in the coming slides. And the revenue centers can be just the revenue centers, so they can be profit centers or they can be investment centers. So, while fixing the responsibility, when we say responsibility accounting, uh, what actually we are interested in is to fix some sort of control on the inputs in relation to the outputs. So establish some relationship between the inputs and the outputs. For example, there are two different business units or departments, and we are giving certain resources to both of them. Then, of course, we cannot just be relieved by giving the same amount of resources to both of them without actually gauging what is the outcome or the performance of these particular business units. So the inputs are actually the resources and especially the financial value of the resources. In the context, we are actually looking towards the inputs. So the patients in the hospital or the clients in a market, in a supermarket, customers, they are not the inputs, right? They physically appear to be input into the market, but they are the customers, right? So the input, we mean by input, we mean the resources. So when we say that it is the question of establishing the relationship between the input and output, then measuring the input is relatively easy in financial terms. Whatever resources we are putting into a department, into an organization unit, it's easy to measure the financial worth of those resources. But it's difficult to measure the financial worth of the output, because the output which is for certain objectives is, even if it is measurable, it is not the only output. For example, the book author says that the sales department, the annual revenues, may not be an important measure of a profit oriented organization unit, because the unit does many other things. For example, so a sales department may do many things which may impact the revenue of the subsequent periods but not the current period. But that per service that will bring the benefits for the future periods is performed in the current period, so it has to be counted in the performance evaluation of the current period. And on the other hand, there are certain divisions for which the output cannot even be measured. So it's the uh, fixing the relationship between the inputs and outputs. So the output side is very challenging. So that's why the performance evaluation measures have to be devised, taking care of this important aspect. So when we say that we are actually integrating, relating input with the output, so there are the concept of efficiency and there is a concept of effectiveness. Although these two terms have been defined differently by different authors, but the way the book author defines them is that efficiency is a measure of the relationship between the input and the output, right? So output over output divided by input. So to increase the efficiency, there are two ways: either you increase the output with the same amount of input, or you reduce the input for the same amount of output. You keep the output constant and reduce the input, right? So uh, efficiency is usually the book author maintains that it's a means of comparison over the two cost centers, over the two different departments. So, for example, we can say Department A is more efficient than Department B if it uses the fewer resources than the responsibility center B, but produces the same output. So the output is same, numerator is same, or it uses the same amount of resources, input is same, denominator is same, but the output is more, right? So now the important thing over here, as we just discussed, that the measurement of output is a challenge in general in absolute terms, but for comparative terms, the author maintains that this is not a challenge, because when you are comparing two departments and they are performing the same level of service, at least we should know they are performing some service and they are at the same, they are at the par. So we don't need to measure, right? Because it's just a comparison. So if the output is same, so we can measure the inputs. So the input can then be measured and they can be compared. So for example, there are two different business units, and both of the business units are actually, say, performing the same kind of tasks, right? uh, One business unit is consuming more budget, the other business unit is consuming less budget. So we can establish the efficiency, that since they are performing the same type of task, then of course the unit which is consuming less resources is more effective than the one, more efficient than the one which is consuming more resources. So effectiveness, on the other hand, as the author maintains, is one version of the effectiveness which this book author maintains, is that it is the, to what extent your output actually impacts your objectives. This is the effectiveness. Whatever output you produce, whether it is you are meeting your objectives or not. So for example, uh, the purpose of, say, a sales department is to actually increase the revenues and the profits for the company. A sales department of a company makes many sales, makes huge amount of revenues, right? So it's efficient with the same amount of input resources, but it may not be effective if the sales are done at the cost of high credit period, for example, with a lenient credit policy. There are huge bad debts as a result in subsequent periods, or they have just managed to sell to customers who won't pay, or they have managed to sell um, in goods which should not have been sold, inferior quality goods, for example. They did know, but they still managed to sell. So maybe this can be one of the example of being effective, although this is not a good example. But the idea that the author gives about the effectiveness is that the output actually is actually contributing towards achieving your objectives. So when it comes to profits, the author maintains that profit is such a measure that if a responsibility center has the element of profit, if it is a profit center or an investment center, we will see them in detail. Then profit is a measure of efficiency as well effectiveness. How? Because profit is actually outputs minus inputs, revenues minus costs, right? So it's a measure of automatically a relative measure of efficiency. And at the same time, since the objective of the organization is actually profit, so profit is also a measure of effectiveness. So the author maintains that when there is a responsibility center which earns profits, then the only criteria, the only KPI that the or management usually is interested in, top management, is the profit, right? So that department has usually are not evaluated on either efficiency or effectiveness, but they are usually evaluated on the basis of profits, right? But if a department is not a profit center, it doesn't generate profit, then we have to fix whether we are going to evaluate the department on the basis of its effectiveness or the basis of its efficiency, right? So usually we will see further that the engineered cost centers are actually evaluated on the basis of efficiency, and the discretionary cost centers are usually evaluated on the basis of effectiveness. So these are the different types. The last slide for this video: engineered expense centers. So there are inputs you can see over here, and there are outputs, and there's an optimum relationship exists, right? So we know that engineer expense centers are, for example, the production department. So production department exactly knows that whatever is the volume of production, they will need the resources according to the volume of production. If the volume of production is double, they will probably need more than single resources, right? Maybe double resources or so. So there is a variable relationship, right? So there is a variability. As the output increase, the inputs will also need to be increased. So these are the engineers expense center. For example, the production, the labor department, the production department, right? The discretionary expense centers, there are inputs which are measurable, but the optimal relationship with the output cannot be actually established, right? So we can know that HR department, accounts department, how much budget, how much resources we are actually putting into, but how much resources are needed actually to achieve a certain level of sales or to achieve a certain level of production is very arbitrary. How much human resource you exactly need, right? In the HR department, how much human resource you exactly need in the accounts department, how much computers you exactly need in the accounts department to cater with the volume of the business, it's very difficult to establish. The revenue centers, we will see, are those centers where inputs are actually not actually counted towards the performance evaluation. So inputs are not related to the output. So usually the sales and marketing departments are the revenue centers, because we don't we don't gauge them on the basis of the profits they generate. We gauge them on the basis of the revenue, the business they generate. So although they have expenses, they have their own expenses, but we do not do that this is the amount of revenue that they kept minus expenses of this particular department. We deduct expenses of all the department to come out to the profit. So the profit is actually worked out at the organization level, not at the department level for the sales and marketing departments. But then we have profit centers. For example, if there are certain divisions which are dealing in a certain product, and they have their own entire production function, they have their own HR, maybe they have their own support facilities. So, for example, the pharmaceutical division of ICI, right, is contributing certain profits. So it has its own infrastructure, support services. So that's the sort of a profit center. So profit center are usually not departments; they are the divisions or the business units. And the investment centers are beyond profit center. We shall see in the next video what exactly the investment centers are. Thank you.